How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you the differences between a fixed annuity versus a variable annuity, and simply explain that. And that's why I entitled it for Dummies. So I don't wish to, offend anybody there. I essentially just want to show you and break down the pros and cons of a variable annuity, and then why some individuals are going more into a fixed annuity, dependent upon their conservative mindset, or more towards a variable annuity based upon their riskier mindset. So, depend upon what your age is, depend upon what your specific goal is, either for growth or income. Each kind of slew is going to pertain to your specific situation over the next person. So, all because you might have heard some chatter online about, a bad thing or a good thing regarding one of these products, it might not suit your needs properly. So just always have that mindset when looking into this, these educational processes of an annuity in general, or the different variations of an annuity contract. Now, within a variable annuity, simply put, this is a type of retirement account or a type of investment vehicle that is set up for individuals, and it's offered through an insurance company. The word annuity is very important because the only types of companies that can offer annuity contracts are insurance companies. An annuity does not necessarily have to deal specifically with annuitization and triggering lifetime income and surrendering your value. Maybe back in the 70s, the 80s, the 90s, when you had the very dry, very cut and dry variations of an annuity, they could only really do one premise. Now, since the early 2000s, mid 2000s, later, in more current times, you have so many different variations on both a fixed annuity basis and a variable annuity basis to make sure that you can mix and mold and figure out which carrier, which company has your specific niche, age, and niche goal that you could leverage to the best degree. So, with any sort of product line, you have hundreds of different carriers out there, and then each carrier offers their own variations, about 3 to 5 different types of annuity products. So therefore, you have thousands of variations that you could essentially have offerings at. So rather than going to, the advisor up the street or looking at an advertisement saying, "Oh, that looks very good," you might be shooting yourself in the foot by doing so. You just want to make sure for every dollar that you're placing into any sort of financial product that you're able to squeeze out the most possible leverage, simply for your benefit, and make sure that you're correlating it specifically towards your goals. So with the variable annuities, it's a type of investment vehicle or type of retirement product that is offered through an insurance company that is linked to some sorts of mutual funds, hence the word variable. So what that means is, just like a fixed annuity, which is going to be a fixed type account, meaning that you could either have it a fixed rate of return, being a fixed 3% rate of return every year, and that's what you're guaranteed. That's what it's fixed at year by year by year. A variable could either give you a gain into your account, or could give you a large negative into your account as well. The downside to variable annuities that a lot of advisors, and also what I typically hone in on, why I don't like offering it to clients, is because the exorbitant amount of fees that are associated with these annuity contracts. What do I mean by that? Well, typically, if we were to go and let's say you have an IRA contract, and this would be a typical example. Somebody has an IRA contract, and now this IRA contract is set up through, is tied to some sorts of mutual funds. There's a fee associated with that IRA, with those mutual funds, and those mutual fund fees are going to be coming out year by year by year. So every single day, every single year that this person is involved with their IRA contract, and they have that tied to the mutual funds, there's going to be a constant fee, every single year. So let's just say that this fee is 1%. On top of it, if you set up an IRA contract through a financial advisor, typically this advisor is going to charge this person something known as an advisor fee or a wrap fee. So that could be averaging, 1.5%, but we'll just use 1% as an example. The third negative or potential negative to this type of IRA contract that's just, sitting there, is downward market loss. So this means that if this IRA is tied to mutual funds and the mutual fund performance goes up, well, then there's going to be a positive credit to this IRA that's linked to the IRA account. So in the beginning of the year, if you had $100,000 sitting in your IRA account, and the market went up 10%, or your mutual funds went up 10%, then you would have a 10% gain into your account. So therefore, it would be $110,000. But the next year, let's say if you had the $110,000 and all of a sudden you had a large loss, let's say a 50% hit, like it did in 2008, well then obviously everything's cut in half. So now your IRA contract would be sitting at right around $55,000 that next year. So you had that large downward market loss, and then on top of it, you're going to have to pay those advisor fees and the mutual fund related fees. So when it comes time for income and you're trying to utilize these types of accounts for income planning and try to provide a type of income stream in retirement, now you have a fourth negative because you're trying to pull money out of an account that could potentially go down, that you're going to have to pay advisor fees and also mutual fund related fees in the process. So a lot of times when you have insurance agents or you might have financial institutions, they're going to try to say, oh, take this IRA account and throw that into a variable annuity. So when doing so, understand that all you're doing is you're accentuating the fees. You might have a higher quality of mutual funds. You might have, you might not be charged an advisor fee onto that account, but you still have that downward market loss, and you still have, when you're turning on lifetime income or income from these types of accounts, that is still depleting your account very, very fast. On top of it, with variable annuities, you have additional expenses such as life insurance type expenses or insurance type expenses, such as mortality expense fees. You have death benefit fees. You might have income rider fees associated with this variable annuity account. So in one aspect, individuals go into a variable annuity because they want to have some sort of lifetime income at a later date in time. Which, yes, that is correct. It can provide that type of lifetime income. But my whole point and why I say that I typically don't like variable annuities is you could get to that finish line a lot on a much more consistent basis and conservative basis through a fixed index annuity with an income rider that has, a fifth the amount of fees than with a variable annuity. On top of it, if you're whatever you do not outlive regarding your money, regarding your lifetime income, you could have a much larger account value that would be left to your beneficiaries as opposed to a variable annuity where that account value is getting beat to hell, every single year based upon those fees year by year by year. So understand when you're looking at these different things, variable annuity versus fixed annuity, variable means it can go up and it can go down. So you don't essentially have that safety net there. A variable annuity can offer something known as an income rider that will provide you lifetime income at a later date, but there's going to be an exorbitant amount of fees associated with that type of income rider, in addition to mutual fund related fees, in addition to the insurance related fees, in addition to downward market loss, and in addition to the negative that's coming out when pulling out income. So I hope that all of that makes sense, and understand this is just a very generic version of it. Each company is going to have their own specific criteria of a variable annuity. There's been times that, I've basically talked badly about variable annuities, and somebody was in a variable annuity. They called over the office. I was dealing with them, and, they were in it for a few years. And I said, there's nothing else better out there. You should really stay put in what you're currently in. And, so there are some times that people got locked into variable annuities when variable annuity contracts are actually offering very good guarantees and very good income plays of lifetime income, where I would say stay exactly the course. There's no reason to kind of switch out of it. But you do have majority of the times that someone calls in and they're getting hit with in between 3 to 7% in fees year by year by year onto their accounts. They didn't know what they placed their money into, and now they just want to get out as fast as possible. So therefore, they could take those dollars and roll it over into a type of fixed annuity that would work similar to the variable regarding lifetime income, but it's going to stop the bleeding a lot better. When I say stop the bleeding a lot better, what exactly do I mean by that? Well, with an IRA, we understand, an IRA type of mutual funds, we understand those negatives with the fees, with the advisor fee, downward market loss, and the income could essentially, eliminate and reduce the heck out of that retirement account. When you do a rollover, it goes from an IRA, and you could roll that over. Advisors try to say, oh, roll it over into a variable annuity. So understand that still in an IRA contract, it's just an IRA annuity contract. So a lot of people think that that an annuity is different than an IRA. It all depends upon where the funds are coming from. So if you're throwing cash into an annuity, then that will be a non-qualified annuity. If you're throwing qualified funds into an annuity, then that could be an IRA annuity. So All it is the annuity doesn't mean that you're just triggering it for lifetime income. All it is the chassis that's set up specifically the insurance company. That's their offering. That's the product that they're offering. That's what it's called, is just an annuity contract. But you have many variations of those types of, of how an insurance company can offer an annuity contract, best to your benefit. And let me clear off the screen. So if someone understands those negatives with the IRA contracts and they say, okay, well, listen, I want to roll it over into an IRA that's more consistent, then they could leverage the fixed annuity aspect. So you have fixed index annuities, you got to fixed index annuities with income riders. You could just have plain multi-year guaranteed annuities, which kind of acts like a bank CD, giving a fixed interest rate year by year by year. So it's just going to give you a more consistent basis of understanding that anytime that the market goes up, you're going to receive a gain into your account, or you're going to receive constant gains into your account, and we're eliminating that reverse dollar cost averaging effect that will hinder your retirement accounts, such as an IRA or such as your cash accounts, whatever the case may be. So with those negatives that I was explaining before, I said, well, with an IRA that's tied to mutual funds, you have those mutual fund related fees. You have possibly an advisor fee. You have the downward market loss potential. And then also when it comes time for income, these are four negatives that are compounding. It's the power of compound interest that's going in a downward direction and liquidating your accounts rather than utilizing the power of compound interest in a positive direction. So that's why with the fixed annuity route, regarding which fixed annuity you go into, the index or just a regular fixed MIGA, there's no mutual fund related fees with that. There's no advisor fees with that. There's no downward market loss because you could either get a fixed interest rate or an interest rate that's going to gain whenever the market goes up or give you 0% whenever the market goes down. So therefore, you have a 0% floor at all times. And then also with income, you have a couple of different variations that this person could do an income play. They could either set it up for lifetime income, and what they're doing is they're utilizing a fixed annuity, then they're tacking on an income rider. Sometimes those riders have no fees. Sometimes they have less than 1%. It all depends upon your situation, your state, the amount of dollars that you're using to place into these contracts. So that's one version of how someone could set up their income or their income planning through a fixed annuity. The other variation would be, okay, if I understand that I'm going to be receiving 3% every year, and I have $100,000 into this account. And let's say this is a 5-year, it's known as a multi-year guaranteed annuity. It's a type of fixed percentage rate annuity. What would happen is every single year this person understands that they're going to be receiving $3,000, $3,000, $3,000, and they could just live off of what that interest is. And this is why fixed accounts were so prevalent and so attractive back in the 80s and 90s, is because an individual was able to leverage $100,000 or any sort of dollar amount, throw it into a bank CD that's paying them a double-digit return or an 8% return, and just live off of that interest year by year by year. And they'd be receiving, let's say if it was a 10% return, they'd be receiving $10,000, live off the interest, $10,000 the next year, live off the interest. After those 5 years or so were met, then they would take the $100,000 because all they were doing was living off the interest, and then they would roll it over into the next best, highest interest credit account. Now, unfortunately, interest rates have dropped to all-time lows, so you can't leverage those bank CD route anymore, those laddering strategies with a bank CD or money market accounts, or even fixed annuities for that matter. Fixed annuities typically pay about 2 to 3% higher than a typical bank CD pays, but still it's at a very low time right now because interest rates are so low. So that's why a lot of people flock towards those fixed index routes that provide growth whenever the market goes up and not lose anything whenever the market goes down. So I hope that all of that makes sense. And what you're doing is you're just eliminating all those negatives that a variable annuity would subject your monies to, whether that's a non-qualified account or a qualified type account. So let me clear off the screen. So when pulling up my bullet points, I have a couple of different things mentioned. I say safety versus risk for accounts. The fix is going to give you a more safe, it's going to give you that peace of mind saying if the market crashes, my money is fine. As opposed to the variable, it says if the market crashes, then I lost all my money. Now, you could have different ties to it. You could have different lifetime income guarantees on both of these variations, but still, when you're utilizing it for a variable, all that's doing is just adding on more and more and more fees. The typical variable annuity is going to average in fees between 3 and 7%. I've seen them very, very high. I've seen retirement disasters with variable annuities, and I have yet to see that with the fixed routes or the fixed index routes, is because it's just more on a safe, consistent basis, saying you're either going to receive a gain into your account or you're going to receive 0% into your account. You're either going to receive a fixed credit into your account year by year by year, or you're going to be living off of that fixed interest rate year by year by year. It's just a more safe, consistent mindset. And a lot of times with retirement, the problem is individuals go and they stay within that risky aspect, and right when they hit their late 50s, their 60s, right when they're thinking they want to retire, and they could see their retirements drop down significantly. Like the individual in 2008 that had $1 million in their portfolio, left it in the market, and then they walked away at the end of that year with $400,000. Those are realistic scenarios. The worst one that I've ever seen is I've seen $877,000, and then by the time I spoke with the lady, it dropped all the way down to $52,000, and that was a little in between 2 to 3 year time frame. And this was just she was invested too heavily in the market. This lady was in her 60s, and the person kept tacking on more and more fees onto her account. She didn't fully understand what was wrong with what she was in, and it was just a really, really sad situation. But these are stories that it does happen. What you want to do is make sure that you have that certainty in an uncertain world. You want to say, or at least my mindset is, and the reason why I created my company around the safe mindset is, I don't want to have an upset client saying, "Oh my God, what happened to my money whenever the market crashed?" Whenever the market crashes, we say, "Well, at least you didn't lose anything because you gained the 0%, rate of return off of that floor." Or you have a fixed percentage rate year by year. You got set up into a fixed annuity rather than the variable. So it's just going to be more of a consistent basis rather than a variable basis. So it's just going to be more certainty in an uncertain world, as opposed to the big question mark, the gamble, the risk, whatever the case may be. So then when you're looking at lifetime income and death benefit, you could have lifetime income tied to a fixed annuity. You could have it tied to a variable annuity. You could do that through the form of annuitization, which I highly recommend against. What that's saying is the insurance company, they're going to always try to give you the most favorable offers off of annuitization, because what this says is you're giving them the money. Then when you annuitize a contract, you surrender your entire account value, and all they're doing is giving you a lifetime income stream. The reason why the lifetime income riders are very important is it allows you to still maintain control of your money up to a point. You might have, in the first couple of years, you might be restricted liquidity, but it still allows you to have that control off of your accounts and still leverage the insurance companies for lifetime income year by year by year. And whenever you pass away, it's not as if you don't leave anything to your beneficiaries. You'd still leave your account value to your beneficiaries, whatever you did not pull out, to your beneficiaries. If you keep living, and your account value goes down to $0, then the insurance company is still on the hook to provide you that lifetime income year by year by year. So it's very, they're very powerful when set up the correct way. The other one is a death benefit rider. This is important for individuals that are not deemed insurable for life insurance. And like a good example would be somebody that has RMDs. So somebody that hit 70 and a half, they might have some different qualified retirement accounts, and all they have to do is keep taking out the required minimum distribution. Well, there's ways on how you could take those distributions out year by year and place them into specifically designed annuity contracts that have death benefit riders, so that by the time that person passes away, if they don't ever need income and they just want to leave an inheritance maximization, that account is going to have a specific guarantee based upon the company that might say, a 5% step up year by year. Whenever that person unfortunately passes away, then there's going to be a nice lump sum that's going to go to the beneficiaries. Rather than just keep taking the money, throw it into a savings account, they could take that money and then leverage it into something that would maximize out that death benefit. So, there's a bunch of different variations. And let me clear up the screen. What I want you to do is, if you found value in this video, feel free to give our 1-800 number a call to speak with a specialist and to see whether or not an annuity contract might be correct for your situation. That's one of the things that we do here at Afasi Financial Group, is we have access to all the different companies out there in your particular area, and then we utilize something that's unique known as the Retire Sharp Planning System that allows us to go through over 1,200 different products and strategies on average per individual that calls in before we give our top 3 recommendations recommendations, but we're not just going to just randomly give you a recommendation and have you not know what it is. We want to educate you first and foremost. You want to be acclimated to the process because this is your retirement. This is your livelihood. This is like getting on a plane that has has a certain percentage of crashing. You want to make sure that you have that safety net. You want to make sure that that you're set up properly so that if a certain company is giving you a guarantee, how safe is that guarantee? What exactly does this mean? If I'm placing $1 in this company, why would I do that? What is the leverage behind doing so? And rather than just go to a random company and it might be okay, with just a random company, what I've seen time and time again is there's companies specific for niche criteria, meaning for a person that's in their 50s that's looking to retire in their 60s, they're in a particular area, there's going to be a whole slew of different options that are going to be a lot more favorable than somebody else that might be in their 60s, looking to turn on income instantly. So I hope that that you found value in this video. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints, and it's because of our methodical process. Thank you very much for watching this. Feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.